Hi, I'm Steve Miller, and the following is a clip out of a member video from our huge trader video library. To see the rest of this video, go to askSlim.com and become a member. And make sure you give us a thumbs up on YouTube and follow us on Twitter at askSlim. So now we're going to look at the bond market, and the bond market has really gone into an accelerated decline, and then today it made somewhat of a recovery. It's been really weak as we were in a bear market and then went to a very long bear wedge and then had a breakdown. That's over several years. And now we've seen this acceleration to the downside. The news out of China that they're not likely as interested in buying our treasuries is significant. After all, the fact that China would buy up our treasuries allowed our government to run dysfunctionally, essentially printing all the money they wanted to. They have buyers for their bonds in all over the world, China being the biggest one. China holds just about $1.2 trillion of U.S. treasuries. And if they stop buying them or they decide to sell them off, well, our yields are going to explode. And our government's going to have a very hard time because, well, the costs are going to go up, and because of the interest rates are going to go up. It's also going to negatively affect corporations everywhere because they've borrowed a ton of money with their financial engineering, and the earnings that they have had that are supposedly justifying, I don't see how they are, but justifying the levels we see in stocks right now, are based on these extraordinarily low interest rates. Some studies that I've seen suggest that if interest rates normalized, that there would be a collapse basically in earnings, and the U.S. stock market would be incredibly, massively overpriced based on that. So there's a lot of risk right now, and we're seeing that as bonds go down and the dollar gets weak. Everybody would think the dollar would be strong, but the money is not flowing to where it can earn the most because it might be actually that it's that area is the greatest risk. So with the potential for policy changes out of Japan or policy changes out of Europe, where the negative interest rate policy won't exist any longer and QE will go away, the dollar could collapse. And that's even more incentive for a country like China to stop supporting the ills that we have here of the way the U.S. government runs. It's eventually the bad players pay, and the markets take over, and we're seeing, I think, the market take over in the bond market on the downside. So that's a long lead into my cycle analysis that I'm going to show you. I'll go back to the bond market and give you we're going to start out by looking at the ZBs because it has our colored phasing in there, and give you a sense for the what I just said about the market. So the bond market started a bear market quite a number of years ago. Now the bear leg that occurred back in from the beginning of 2016, which took the 30-year down from 177 all the way down here to 146. That bear market went into a bear market upside correction in the form of a wedge that you can see right in here. In there are we're looking at 6 cycle periods. First of all, there's a big cycle period that you can see right in here, and each of those is made up of 2 smaller cycle periods that you can see right in here. They run 12 to about 15 weeks. And you can see the consistency in there, and you can see 1 right here, 2 right in here. That made up the bear market. And then the upward consolidation had 1, 2, and 3, and the third one brought you the breakdown under the wedge. The cycle that we're in right now, and I'm going to blow this up for you to see, is this one. Now, the previous one having a negative configuration, in other words, closing lower than it started, warned us that this one would fail in the resistance zone. and you could see that it did so. Then once it got under threatening this low, this turns yellow. Once it breaks the low, this turns red, and we get into a negative period right there. So this negative period has about another month to it. This is February 5th that it points to. So that's 3 or 4 weeks from now, where there is still downside risk in here in the bond market. The worst projection we have in the 30-year is about 146.30, about 3 points lower than where it is right now. But you can see this downward market. Then in a little bigger picture scenario, assuming that happened, we got another decline in here. Doesn't have to be that deep. Then you got another rally that fails somewhere halfway up or so in here. Maybe that coincides with a stock market correction and a flight to safety, and then another bear market leg out over here. So this is a negative scenario. We have been extremely bearish in here in the bond market, and that has been extremely accurate. Here's the shorter term patterns that we're looking at in here on the daily chart. And you can see in here, note the hammer bottom right over there. So this is this day right over here, or within the next couple days, is when a minor bottom is suggested based on these. You can see these smaller patterns right in here, all those the same length. Here's your cycle rhythms that you can see right in here, extraordinarily strong messages. The failure at resistance on the daily chart, just like it did on the weekly. That's a different resistance on the daily, and then comes down and breaks down to a lower low. So we have negative configuration here in these last 2 cycles, and that is a lower low here and then a lower low here. This is likely to rally and then fail and then get you another lower low over there. So all of this that we're looking at is a very negative scenario. You can see right over here this cycle low. That's where it got this morning. The low for the day is 149.03. This right over here is 149.03 or 4 on that important cycle low. We said if violated, it's a major warning at that point, and it held up just at the number and then bounced. We kind of think that's made a little bit of a bottom in there, but we're going to get only a minor rally in the bond market, and then likely another move to the downside after that. The same scenario when you look at 10 years, except 10 years are weaker, and that's a reflection of the yield curve flattening. So in other words, the rate of increase in the 10-year in interest rates is stronger than that in the 30-year. So the flattening yield curve is reflected by the steeper move on the downside in the 10-year. Again, we're looking for 3-4 weeks on the downside in here. Same scenario, same bear market that you saw right in here, same upward retracement within the wedge, and a breakdown that came here earlier actually. And that gave us a good warning, and after that breakdown it moved down pretty significantly. I didn't mention momentum in the when I looked at the 30 years, but you can see right in here the momentum negative. The slim ribbon is what we look at for our momentum on these charts. And here's that down arrow right over here, and that told you that it's likely that there's going to be an accelerated decline. And that's, of course, what you got. The slim ribbon here still negative. That's why these colored bars are red, because when the slim ribbon turns negative, the colored bars are red. When it turns positive, which I don't have much to show you in there, they turn green, and when they're neutral, they're gray. So it colors the volume bars also, so you know when you're in a positive or negative momentum. That's why I leave volume on this chart. So again, we're looking for a minor rally in here. The rally up into, well, 123.08 to 10 would be a reasonable place for it. That's not very far. And then likely rolling over again as we have projected. So the bond market, extraordinarily weak when we see this. Outside influences are pushing it, but you know, you can't blame China. You can only blame the U.S. government for building this massive amount of debt. At some point, we're going to start to get auctions that are going to look crappy. We're going to get huge tails on the auctions, and it's going to show you that people don't want to buy the bonds anymore, just like China doesn't. So China doesn't because of what the U.S. has done. It's not, you know, they might be fighting a trade war doing that right now, because there are definitely trade tensions going on between the U.S. and China, but the U.S. gave them that capability to do so. So it's a bad scenario for the bond market, and we think that rallies will come and fail. You just saw the opening of one of our special member videos. If you'd like to watch the rest of that video and have access to our huge library of videos for traders and investors, just go to askSlim.com. In fact, right now, if you write to me, slim@askSlim.com, I'll send you a special half-price link for our entire video library. 1 month viewing of all of our videos, $16.50. I hope you write to me right now.
I'm going to the city and I'm gonna do a slim.